Right now, there is a tax in Australia that can take up to 32% of your superannuation, and almost nobody it hits is alive to see it. It does not appear on any bill while you are living. Your fund never warns you about it, and the person who pays it is usually your own child, months after your funeral, when a smaller number than expected lands in their account. It has no official name. The tax office does not call it a death tax, because officially, Australia does not have one. But it is real. It is written into the Income Tax Assessment Act, and for a very ordinary reason, most families never see it coming until it is far too late to do anything about it. Today, we are opening it up using the exact rates the ATO is applying right now and the real tribunal cases where families fought it and lost. Start with the number that surprises people most. When you die, your superannuation does not automatically belong to your estate, and it is not automatically tax-free. Whether a single dollar of tax is paid comes down to one question: who receives it? And the tax law splits the entire population of Australia into just two groups: dependents and non-dependents. If your super goes to a dependent, the whole thing is tax-free. Every cent, taxed element and untaxed element alike. There is no cap, no threshold, no paperwork. A spouse simply receives it clean. But if that exact same balance goes to a non-dependent, the tax office reaches into the taxable portion and takes 15% plus the 2% Medicare levy on the taxed element and 30% plus Medicare on any untaxed element. 17 or 32% decided entirely by who is standing at the other end. And here's the trap hiding inside that one word: dependent. For tax purposes, your independent adult children are almost never dependents. Same money, same super, same person who loved them, and a completely different tax outcome, depending on a definition most families have never read. So the first thing you need to understand is who the law actually counts as a dependent, because it is far narrower than the ordinary meaning of the word. Section 302 to 195 of the Income Tax Assessment Act lists them precisely: your spouse or former spouse, your child under the age of 18, anyone in an interdependency relationship with you just before you died, and anyone who is genuinely financially dependent on you at that moment. Read that list again and notice who is missing: your 35-year-old son, your daughter with her own career and her own home. The moment your child turns 18 and stands on their own feet, they fall out of the tax-free category and into the taxed one. The people you most want to leave your super to are usually the exact people the tax office will tax on it. Now, the part that decides how big the bite actually is, and this is where almost every explanation stops too early. The tax does not apply to your whole balance. It applies only to the taxable component. Your super is made of two parts: a tax-free component built from the after-tax money you personally contributed, and a taxable component built from every concessional dollar, employer contributions, salary, sacrifice, and all the investment earnings across your entire working life. For most Australians who have been building super for decades, that taxable component is the overwhelming majority of the balance, and that is the answer to why this tax is so quietly brutal. The bigger and more successful your super, the larger the taxable slice, and the more of it the tax office collects when it passes to your kids. Let me put real numbers on it, because the percentages hide the size of the loss. Say you die with $600,000 in super. $150,000 of that is the tax-free component, and $450,000 is the taxable component. All of it taxed element. It passes to your adult daughter. She pays 17% on that $450,000. $76,500 gone to the tax office. Money that was already taxed once when it went into super, taxed again the moment it comes out through death. Your daughter inherits $523,000 instead of $600,000. An effective rate of nearly 13% on the whole balance, and it can climb higher if any part is an untaxed element. And there is a worse version of this that catches people with insurance inside their super. If you hold a life insurance policy in your fund, the payout it triggers on your death can become an untaxed element. That is the 32% tier, not 17%. A family expecting a tax-free windfall from dad's life cover can watch nearly a third of it disappear, purely because of where the policy was held. This is the cruel mechanics of it. The structure that saved you 15% tax every year while you were alive is the same structure that taxes your children when you die. Super is a 15% environment on the way in, and for your non-dependent beneficiaries, it can be a 32% environment on the way out. Now, people always ask the same question at this point. Can't my adult child just prove they depended on me? And this is where I want to show you something most videos never will. What actually happens when families try. The tax tribunal is full of these fights, and they are brutal to read. In one ruling, a son lived with his parents his whole life and paid $150 a week in board. The tax office ruled that was a normal commercial arrangement, not dependency, and taxed the $500,000 benefit in full. In another, a parent cared for their own terminally ill adult child, financially and physically, and the tribunal still ruled it did not count because it did not go, in their words, beyond the normal relationship between a parent and an adult child. The bar for interdependency is extraordinarily high, and the tax office defends it hard. You cannot assume your family will clear it. So here is what the people who plan ahead actually do about it. And it is completely legal. It is called a recontribution strategy. Once you are over 60 and allowed to access your super, you withdraw a large lump sum, tax-free, and then you put it straight back in as a non-concessional contribution. That recontributed money re-enters your super as tax-free component. Run it on our earlier example. You pull out $330,000 and recontribute it. The taxable component drops from $450,000 to $120,000. The tax your daughter would eventually pay falls from $76,500 to about $20,400. You have just saved your child roughly $56,000 with a piece of paperwork. The non-concessional cap is $120,000 a year, or up to $360,000 using the 3-year bring forward rule. So it usually takes planning across a couple of years to move a large balance. And do not assume this is a rich person's problem. The Australian super system now holds over $4 trillion, and the generation that has been contributing since compulsory super began in 1992 is now reaching the end of life with the biggest balances the system has ever produced. Treasury's own modeling expects the tax collected on death benefits to rise sharply over the next 2 decades, precisely because ordinary Australians are dying with 6-figure balances they never managed to spend. The tax office is not waiting for millionaires. It is waiting for the median retiree who did everything right, saved diligently for 40 years, and left it all sitting in super because nobody ever told them that the safest place for their money in life becomes one of the most taxed places to pass it on in death. So bring it together. Your super is not automatically tax-free when you die. If it goes to your adult children, the tax office takes 17% of the taxable component, 32% if any of it is untaxed. The law's definition of dependent is far narrower than yours. The tribunal enforces it without mercy, and the bigger your balance, the harder it bites. But a recontribution strategy, done in your 60s, can wipe most of it out entirely. The uncomfortable truth is that this tax is voluntary, and almost everyone pays it by accident. The families who see it coming keep tens of thousands of dollars in the family. The families who do not hand it to the tax office without ever knowing they had a choice. If this changed how you think about your own super, hit the like button, subscribe, and turn on notifications so you do not miss the next one. I'll see you there.